At first, when one sits down for a conversation with Ronnie, maybe taking a line from one of his super hit movies, one should ask, how's the Josh this evening? How's the Josh, Ronnie?
Very high. Very, very, very high. Ask everyone there how it is.
How's the Josh, guys? So you're supposed to say, very high, sir, from a line from Uri, the super hit movie Ronnie Screwvala produced. So, Ronnie, I mean, you are a multi-diversified individual wearing multiple hats. Serial entrepreneur, a movie mogul in that sense, and also now an edtech founder. How has it been? Could you just take us through the first initial years of your journey as an entrepreneur? What were the initial challenges and what were the lessons from failure, if one were to ask you that? Because there are quite a few startup founders here in the audience as well. So what would you sort of advise them?
Well, look, firstly, I think it's a generational shift. So what happened maybe 20, 30 years back is no longer relevant because what happens 2, 3 years back is actually not getting relevant. But I think some virtues stay the same. I think my background, I came from a lower middle class home, and therefore entrepreneurship was not the normal spoken word. And I say that because I think there were true sort of values that for me stood out the test of time. One is a complete lack of sense of entitlement. I think when I decided to get out there and start something, my dad told me, go ahead, after 6 months though. But whatever you do, I'm not there to bail you out financially. We'll be there morally for you. So that kind of stays out there, and I think we had some very sharp one-liners from everyone here in the previous panel. So I think everyone has their takeaway. That kind of drops your level of entitlement, and I think that kind of puts you in a very different perspective for the long term. I know movies is a glamorous part of the business, but I think building a media entity is 10 times more challenging than actually just making a movie.
True.
I think that was the earliest stages. Today, I think when people start out and become entrepreneurships, they have a focus on an idea. I think when I started, just crossing the bridge on deciding to be an entrepreneur was the first one. And the first line for me was not, I have a great idea and that's why I wanted to be an entrepreneur. I think my context was, I don't think I can implement somebody else's vision, and therefore I better start up on my own.
So it was always something you wanted to do, kind of a be your own boss kind of a scenario.
I think that needs to be really very strongly with anyone, right? I mean, it has to be something where you need to feel you're going to kind of back that. Which is why I think when people talk about at some stage when you go from 0 to 1, 1 to 10, but there is a founder aura that remains with an entity for a long, long period of time. And I think there's nothing wrong with that. I think the organization structure might change, but that aura, that vision, that velocity, that clarity of thought, I think is going to be very, very important to see through.
But you know, as you scale up, Ronnie, it's never easy, right? I mean, 0 to 1 may be still somewhere possible. But as you become bigger and bigger, when your ambition actually takes over and you want to take the company to the next level or the venture to the next level, that becomes more difficult. So how does, what would you advise entrepreneurs who want to scale up and become even bigger than they've,
Firstly, I think everyone needs to be comfortable. Not everyone is comfortable with scale.
Right.
It's a nice word. It's like everyone saying, I want to go global. I think you need to think 10 times before you actually look at that. So I think we have that as a sort of a mesmerizing, romantic thought. Firstly, are you ready for that? The second is your organization ready for that? Because the probability of failure while you're scaling could be even higher. So I think you need to measure what you need to do in a market. Some people may want to just go for higher margins and profitability. Some can go a lot more in terms of focus. So I think scale is not the only idea. It just sounds very, very strong that you need to build. Now, the problem in India is whatever you do, you need to solve at scale. And it's not a high margin business in many aspects, so you need to have a larger common denominator. So I think from that perspective is there, but my advice would be ready why you're doing what you're doing, because that in itself is going to be the benchmark of success, because actually scaling and that road is very tricky.
Let's come to your, the part of your journey where you were a very established media entrepreneur and then sort of moved away from that again to start a different leg of your journey. What were the key takeaways from the entire Disney transaction?
Well, firstly, I think in any transaction, if you're approaching somebody for an exit, you're going to get half the value. So I think somehow or the other, you've got to figure it out the other way. Second is, if it's a planned exit, chances are it's going to be half the value. I think it has to happen in a particular manner at a particular stage in what you want to do. Because this whole plan of I'm going to build this and in 4 years I'm going to exit, you're building it not in your own vision, you're building it for somebody else's vision. So I think specifically with Disney, and look, I think even when I exited, which was now 12, 13 years back, in 2012, exit was not a good word. I think about 100 people called and said, you're abandoning the media sector, you're abandoning the company. Today, of course, after 2015-16, we had a lot of new and e-commerce companies taking exits, and it became a very glamorous and a sought after word. But in just as recently as 2012, it kind of wasn't. But I think for me, it was the crossroad of working with an incredible partner and a brand that was 100 times of what I had built, which is the Walt Disney Company. We were working together in India. They popped the question. It made eminent sense. Over a period of 30 days, did I have an answer what I wanted to do next? No. Did I believe that media needed the next $1 billion, $2 billion, $3 billion in investment? And if I got diluted, who would I be working for? I think those were the cross sections that came in there. Plus, there was incredible amount of disruption in the space happening. So I thought this is the time to maybe shift gears and look at it in a slightly more different manner.
So no regrets there about the time and at that stage when you exited.
No, I don't think life gives you that opportunity because this, in hindsight, is a waste of time. But in spite of that, I would say yes, no regrets.
And then, of course, you went back to what you do best, which is being a serial entrepreneur and choosing very, very interesting ventures. Some of them are on the verge of going public as well. Some of them, like Lenskart, for instance, you were one of the early investors, which has now become a very large venture. How do you go about, Ronnie, choosing the investors? It's often said for serial investors or venture capitalists that they choose more often than not, they choose the person, the entrepreneur on whom you're putting in the money rather than the venture or the idea itself. Is that true? Do you also go by that?
Oh, absolutely. I think it is very, very true in that. And I think not wearing an investor hat, but wearing an entrepreneur or founder hat and looking at a business from the other side is a very different view and a different glare. And I think the way one has worked with the founders there, you just bring in a different sense. But yes, what you're looking out for. I mean, today I think a lot of people, and I talk to people in my company where people say, when you're looking for a founder, I'm looking for vision, I'm looking for clarity, I'm looking for problem solvers. I mean, today I think we need to look at problem spotters rather than problem solvers, because the world is not giving us enough time to solve problems. I think the sharp ones are going to be so nimble, so sharp, that they've got to be problem spotters. But I'll give you the anecdote as far as that is concerned, specifically on Lenskart, because at the time I was the second investor there, and I think when I went there with the founder and Piyush, and there were 4 cards at that time, a Lenskart, a Bags card, a Jewels card, and I think one other card. And I said, look, I'm going to invest, but you need to shut 3 of the cards down. And he thought I was negotiating. And I said, no, it'll be the same value. But the real focus of what you may want to do is something different. So I think that is something that you can do because you've lived it. You've been able to guide it to a certain level, and you can pop the question there.
So as an investor, do you also mentor your investee company?
I don't think anyone needs mentoring. I think mentoring is a little bit of a dangerous word. Frankly, if you ask me. I think having conversations with colleagues and founders at different age groups, different sensibilities is important. But mentoring is dangerous because you can't really put yourself in somebody else's position and you can't take everything on that guideline. So I think mine is a much more conversational approach. And I think if you can ask the hard questions, 5 more hard questions than what the person you're having a conversation with, you're adding value.
And typically, what would be your investment horizon like? Would you like to stay on and see the company grow, go public?
Yes, I think so.
That's typically the kind
it's not the treadmill. I mean, the beauty of this is I don't need to form another fund. I don't need to figure out the next level. I don't need to have a liquidity. But it also gives you the timing that when you want to hop off, you can also hop off in a very different manner.
That's right.
Yeah.
That's also very important from an investor point of view. Coming to the startup ecosystem, which now, India is now the third largest in the world. However, there are, dark spots. There is a kind of there are problem areas in terms of governance. As an investor who has seen some storied founders, done well with some of them, what is your advice to some of the startup ecosystem, the founders, or maybe those who want to set up ventures tomorrow in terms of governance?
Look, firstly, I would say, I don't think it's a problem unique for India, so we shouldn't wear the hat on it. I think governance is an issue in many other developed countries. In fact, those governance issues go even deeper. Second, I think we look at governance in a very simplistic sense about statute, the board of governors, returns, financial. Actually, it starts at the very basic element of what's the motive, right? Because if you're transparent and you know exactly what you want to do, so I think the governance really starts with the founder and the team that the founder has built, and then the management ethics that go there. You can't spot governance and correct it. You have to go back to the root of it. And I think today for startups, that's what it's going to be. If we really want to create value, and look, legacy businesses and families were at one stage where the tax structure was so high that you felt removing money from a company was more profitable than the value. Today, it's exactly the opposite. So your real value, your price-earning multiple ratios are going to go up based on your integrity, your clarity. So I would say governance is also about the integrity of thought, integrity of planning, clarity of thought, because once you have that, you won't need to cut corners.
But do you think there's also, in some cases, an element of greed that when there is valuation, you see the valuation, and it's happened in some cases, Ronnie.
Of course, greed is a natural phenomenon.
We are not talking about Gordon Gekko saying greed is good necessarily.
Yeah, so I'm not compiling on that, but I'm saying that is a natural thing that would happen. But there are both sides, right? Because private equity investors, when they create FOMO, they're equally at that contributing table for what they want to do. But I think today, I've at least find with private equity investors, and look, they have a great track record, but my challenge is that when they get there, they've got to take hard calls. I've seen a lot of people where I said, if the founder is not working, what have you done to improve the corporate governance? So that's the stage when they get soft and say, but my reputation is I don't want to take on a founder. And I'm saying, but then actually, you're compromising your own responsibility.
Absolutely.
And I think that crossroad today we haven't really crossed, where when you're building a company and you're doing a repertoire and you've got 20 companies to invest in, why take on 2 founders? You can move on to the 18. That makes sense for you, but it's not contributing to the ecosystem. And the culture in startups is not to have independent directors right at the beginning. And those independent directors have a challenge because you have private equity investors on one side, you have a founder, and then you have an independent directors. So I think it's a tricky situation, which actually goes back to the ethics, the transparency, and the thinking of the founder.
Do you think, some startups have started doing this, maybe egged on by venture capital or whatever? They've started sort of taking on senior people from larger companies, either as board members or as full-time executives, senior executives, top management. Do you think that helps when you get on to...
It would help if you're willing to listen. Everything helps. But you don't need that. If you're willing to listen, a lot of things help. Right. If you're not willing to listen, but you want that more as semantics to actually show that that's what you're going to do, that's even doubly dangerous. So I think when you're in that early stages and you've got a board, and that board is with private equity investors, look, there is a little bit of conflict and there's a little bit of synergy with it, right? Because the conflict is they want you to figure out how to raise more money so they can do a mark-to-market, but they also want to see the long-term aspects. So there is that little bit of friction. My challenge with a lot of founders is the more capital you raise and the bigger your board, that's going to be 30% of your time. So if 30% of your time is going to go to HR, which is what really organization building is, and 20% is going to manage a diverse set of investors, that's not allowing you to go out and build your vision.
But then shouldn't founders spend more time engaging with the board and looking at broader strategy rather than
they could and they should. They could and they should. And that I would like to volunteer another prickly point here, because I think a lot of people, and that might not appeal to a lot of people here, but I think there's a sense of entitlement also with founders where they've come down to 5%, 10%, 15% of the company that I want to claw back. Now, as a founder, I can say that, not as an investor, I think it's a bad idea. I think it's a bad idea to have a clawback because you took the call to raise the level of money you wanted to raise from time to time to get yourself to this dilution. It's worked well, you've created value. If it hasn't worked well, you've created less value. Accept that and move on from that perspective. Because if you then get topped up every time because you say, well, who am I motivated for? 5%. Your concept of return for capital employed is going to be very low. And when you get in the real world of a listed company, it's going to be a problem.
The other point is now that many of these startups are now going and getting tested in the public markets. So the private market valuation is something you deal with private equity or venture capital, and then you have the retail investors and the vagaries of the public markets. What is your advice for those who are now on the verge of accessing the public markets?
If you're not doing your valuation based on chest-thumping moments, you're good. You're going to be fine. But if you are trying to benchmark and say, let me do this, so that when I go public, it's going to be one step up, you're going to be in for a nasty surprise, because 9 out of 10 times, that's not going to match. Which is why I think today, for the first time, in the last 4 or 5 years, you're seeing a complete change of dynamics, right? Because the good news is you don't need to go to 5 foreign destinations to complete an IPO. The tough news is you've got Indian large funds that are setting the benchmarks and saying just because 2 people, individuals, set a benchmark for your company and a valuation 5 weeks back or 5 years back or 5 months back, doesn't mean I need to follow it. So I think that if you're in the place of building the value for which you want to really do that, I think you're fine. But if you're doing it to keep benchmarking, I think that's where the gap is coming in today. The biggest problem is you took in 4 investors, they created value, you gave them value. Now the next 1 million people are going to come into your company. If you're not switching tracks to figure out not to optimize this IPO valuation, but over the next 5 years how value is going to be built, that's the next 1 million people you need to cater to, because thankfully you've catered to the 4 or 5 or 6 investors you had before.
So we've run out of time, Ronnie, but the last question, you're now building Upgrad into a large edtech company. What's next for Ronnie Screwvala?
No, nothing's next. I think, more than that, I think my sense of pride, I think the balance for me today is rolling up my sleeves and looking at a startup all over again. Our foundation, the Swadesh Foundation, named after one of the movies we created long back, which at that time didn't do well, but today is now much more evergreen than ever before, and some of my passion projects.
Ronnie Screwvala, ladies and gentlemen, as always, an absolute fascinating conversation. Thank you so much, Ronnie.